Hello and welcome to Crossing the 49th, the Cross-Border Tax and Financial Planning Podcast. I'm your host, Phil Hogan, and today we're going to go through some more cross-border Q&As. All right, so today we're going to walk through some more cross-border Q&As. I get lots of questions, so this is always a good opportunity to work through some of these questions, get some answers, and hopefully you'll find this helpful if these are questions that you've had as well. A little bit of housekeeping before we start. I always like to give a big shout out to everybody on the Facebook page. We're over 7,000 members now, so big thank you to everybody for their contributions. Lots of questions being asked on there, especially in the last couple of weeks, lots of new members. So once again, big thanks for everybody that's helping answer some of those questions. And in the next few days, I'm hoping to have an immigration lawyer join us on the Facebook page to be able to answer some of the immigration questions that I'm just, it's not my specialty. It's not something I probably want to dive into and really start answering immigration questions. So we're going to try to get somebody on the board there to really help with those questions. So yeah, once again, thanks everybody for participating. And don't forget, I say this all the time, if you haven't subscribed to the channel, make sure to subscribe to the channel below. Once you do that, then you'll ensure that you don't miss any new videos that get posted. Okay, so let's get started. Question number one. I'm moving to Canada. Should I sell my principal residence or rent it? Once again, we get this question a lot, and we're still getting lots of questions from individuals that are thinking of moving to Canada. With most of these questions, I'm not going to get into real detail, but just give you some general understanding of what you might want to plan for. If you have any questions about these, once again, best place to reach me, phil@philhogan.com. Send me an email with lots of detail on what you need. And if I can't help, I'll do my best to try to find somebody that can help. So yeah, question number one, I'm moving to Canada. Should I sell my principal residence or rent it? There's nothing wrong likely with renting the principal residence after you move to Canada. The biggest challenge is likely not losing your principal residence exemption in the US. So as we know, if you sell a principal residence in the US and let's say you own it jointly with your spouse, and you sell that property, you get up to a $500,000 gain exemption. But that only works if you've held the property or lived in the property for 2 out of the last 5 years. If you go beyond that 2 over the last 5 years, so if you move to Canada and you rent it out for 3 years, then you're not going to meet that 2 out of the last 5 year rule. Therefore, you won't get the $500,000 exemption on your principal residence. So that could really be problematic. What could end up happening is you could have, let's say you have a $500,000 gain on your principal residence because you purchased many years ago. You move to Canada, you rent it out, you go beyond this 2 out of the last 5 years, you go to sell the property, and you have a $500,000 gain. That's a fully taxable $500,000 gain on the US side. Whereas if you sold it beforehand and you lived in the property 2 out of the last 5 years, you'd receive that $500,000 exemption, therefore no tax on the sale of the principal residence. So really important to look at your principal residence before you actually make the move, so we can do that planning. And once again, if you rent out the property just for a short period of time, nothing wrong with that. You'll pay tax on your rental income in the US. It'll be taxable in Canada as well. But to the extent that you pay tax in the US, you'll get a credit in Canada. Okay, so question number two. We're getting this a lot. I had huge gains in 2001 that I paid tax on, but now huge losses in 2022. What can I do? So we're seeing this a lot. So of course, the stock market's been very strong over the last couple of years, other than this year. So what we're finding is, especially in 2001, we had lots of clients with very significant gains in the 2021 tax year. Paid tax on those gains, and then we come to 2022, where after November of 2021, the stock market's really corrected quite a bit. And now a lot of clients have locked in capital losses. So they paid lots of tax on capital gains in 2021, and now they're realizing some losses in 2022. And what can they do? So once again, this is a longer topic for sure, but let's just talk about this from a Canadian perspective, and then we'll talk a little bit on the US side. So from a Canadian perspective, the nice thing about Canadian capital loss rules is you're allowed to carry back losses from a current year back 3 or carry forward losses indefinitely. So if you incur a loss, you have the choice to carry it back to years where you actually had capital gains and offset those capital gains, or just carry them forward indefinitely. So in cases where you have large gains in 2021, so let's just use some numbers here. Let's say you had a $500,000 capital gain in 2021, and then in 2022, you realized a $200,000 capital loss. So that capital loss, once again, we have the option of carrying that back 3 years or moving it forward indefinitely. Now, assuming if you didn't have gains in 2020 or 2018 or 2019, you would just carry it back to the 2021 year. But you would want to go back as far as you can, depending on what your income levels were. But let's assume you didn't have any losses in those other years. You would carry it back the $200,000 to the 2021 year, and then you would recoup taxes that you paid on $200,000 of gains. So long story short, you're not going to lose those losses. You'll be able to use them. If you didn't have gains in the current year, 2021, they just get carried forward indefinitely. Now, that's a lot different than the US side, and that's why for domestic residents of the US, you want to be careful that you don't realize a bunch of gains in 1 year, especially if you have losses to offset them, and then in the next year start realizing losses. So long story short, if you have losses, carrying back on the Canadian side 3 years, forward indefinitely. On the US side, you can carry them forward and get a deduction for $2,000 a year, $3,000 a year, or you can offset them against gains in the current year. Not often an issue, because on the US side, you're not going to necessarily, especially if you're a Canadian resident, pay tax on your capital gains in the US. So much more of a Canadian-centric issue for sure. Okay, question number 3. I've inherited an IRA from my late mother. Should I cash it out? Okay, we get this a lot because we really help clients a lot with inheritance. A lot of the answers to these questions really do depend on the size of the IRA. So I would say if you inherited an IRA that's $10,000-$15,000, especially if your income's quite low, it might just make sense to cash it out, bring it up to Canada, maybe put it in your TFSA, or you use it to pay down debt, whatever you might need to do. If you inherit a sizable IRA, something over 200,000, and we've seen this in the last couple of years where clients are inheriting pretty significant IRAs, I certainly would not think about cashing that out, especially initially, because what you'll be able to do, you'll be able to actually defer the taxation of that IRA for 10 years. So the idea is if you cash it out, you're going to pay, not only you're going to pay US tax, you're going to pay Canadian tax, which is much more relevant because the Canadian tax rate is going to be much higher. So let's use an example. Let's say you have $100,000 IRA, you cash out. Your marginal tax rate in Canada is 30%. So you're going to pay $30,000 of tax on that withdrawal. If you don't need the money, it doesn't make a lot of sense to pull the money out. You want to continue deferring that over 10 years. Hopefully you get to a point in the 10 years where you can actually start withdrawing that at a much lower rate. So if let's say you're working currently, your average rate's 30%, but you're going to be retired in a little bit. In retirement, let's say your tax rate drops to 10%. That's a 20% differential on the $100,000, $20,000 of tax savings. So definitely would not recommend just withdrawing money from the IRA just because you've inherited it. You can have it deferred for the 10 years, and then in most cases save a bunch of tax for sure. Okay. Once again, very general comments. I mean, we really want to plan for these IRAs when they come through, but for purposes of this conversation, that's maybe a good idea. Okay, so question 4. I failed to send in a US extension by the 15th of June. Will my FBARs be penalized? Okay, so you definitely want to make sure that you always file an extension for your US return, regardless of whether you think you're going to file it by June 15th. If you're getting close to June 15th, just file the extension, because it's not even necessarily the tax returns that are problematic. Some of the forms in the tax return that carry ridiculous penalties. So obviously, a form like something like 5471 carries a $10,000 penalty if it's not filed on time. And you can avoid that simply by filing that 4868 extension. So whenever you can, just file the extension every single time. Now, you're lucky here because FBARs are automatically extended to October 15th. So the rule is they're going to be due at the same date as your tax return, which means you would, if you're living in Canada, will be due June 15th. But then there's this odd rule that says that if you have an FBAR, you don't have to file it till October 15th. So essentially the FBAR deadline is October 15th. So you have till October 15th to file the FBAR, but just make sure you do it well beforehand. The FBAR penalties are significant. And it's not that we see these FBAR penalties a lot, but you don't want to put yourself in that situation. So file the FBAR well before October 15th. Okay, question number 5. I was told by my accountant that I should only be taxed on U.S. dividends in Canada, but CRA reassessed my return. So I'm not sure exactly what happened here, but it sounds like somebody received advice that their US dividends were not taxable in Canada, which is incorrect. And then CRA likely had a slip, and they matched the slip and they taxed the amounts on the taxpayer's tax return. So it's true that US dividends will be taxed first in the US and then taxed in Canada. So you'll pay a level of tax in the US. So for non-residents of the US, you'll pay 15%. Residents of the US, you'll pay whatever your dividend rate is in the US. So let's say you paid 15% in the US, and then in Canada you paid, pick a number, 30% if your if your tax rate's high. So you pay 15%, you'll get a credit for 15% for the US tax. Therefore, overall, you paid 30%. So, and we see this a lot. People are given advice that US source income is only taxable in the US, Canadian source income is only taxable in Canada. Sometimes that's true, but in most cases, you will report your worldwide income on both returns and then take foreign tax credits to offset each source of income. So if CRA reassess your returns, what you want to make sure you do, they've included the income, but make sure that they've also given you a credit for any U.S. tax that you paid. So whether if you're a U.S., it's not clear here, but if you're a U.S. citizen, it'd be the tax you paid on the dividends on your U.S. return. If you're a non-resident of the U.S., it'll just be the withholding tax that they withheld when they paid the dividend. Yeah, so make sure you don't miss out on that foreign tax credit. Okay, so last question before we wrap up. My corporation is receiving income from the US. Do I need to file a US tax return? Very good question. So we get this a lot. Good example, let's say Canadian corporation doing consulting for a US company or a US individual. They don't go down to the US. They're simply doing the consulting from Canada through a corporation. So under US law, in order to receive treaty benefits for the treaty provisions that only tax business income in the country where there's a permanent resident, you need to file a tax return. So very generally speaking, if you do business in a country and you have a principal residence in that country, regardless between Canada and the US, regardless of where the money comes from, as long as you have a permanent establishment, like a fixed place of business, in that country, that's where the income will be taxed. So the corporate income will be taxed in Canada. However, in order to file that treaty election, what you'll need to do is file an 1120F corporate tax return. So the 1120 is a corporate tax return for US purposes. 1120F, being foreign, is a foreign corporate tax return that you file. It's not a full tax return. You really just show the amount of gross income that you've received. You take a treaty deduction for that. You include an 8833, which is a treaty disclosure form, just to show the IRS that you're not taxable on this income. Now, that might seem silly, which in a lot of cases actually is. It would be nice if these treaty provisions were automatic. The challenge and the danger with not filing the 1120F, the IRS has the ability to tax you on gross income if you don't file this 1120F with the treaty election. So terrible situation, like a good example, we file lots of 1120Fs. Let's say you had $1 million of income, or let's pick a lower. Let's say you had $100,000 of income from the US, but you had $80,000 of expenses. So your net income is only $20,000. The US is actually taxing you on $100,000 of income if you don't file this 1120F. Now, of course, that would be disastrous because you didn't make that much money, certainly, and you're getting taxed on it. And there's not really a great way to get abatement on that. So you never want to put yourself in a position to file the 1120F late. So if you have a corporation that's doing business in the US, make sure to talk to somebody and then make sure to file that on time. And if you can't file it on time, the 700 form is available to file an extension for the 1120F. Okay, so I think we're going to wrap it up here. I just wanted to run through some common questions or new questions that I've received. Hopefully these will be helpful to some of you that had the same questions. Once again, if you need to reach out, best way to reach out, phil@philhogan.com. When you do, please, lots of detail in the email. So hopefully if I can't help, then I can find somebody else to help. Once again, big thanks to everybody supporting the channel. Again, if you have not subscribed, please do so. And then you can also click the alerts button to be notified when we drop a new video. Thanks again, and we'll see you soon.